Hello, Avila Advantage Finance students. We are now in our final week, so congratulations, everyone. You're almost done, so I get to celebrate the holidays here quickly. But in our last week, we're going to focus on just Chapter 16 and a couple homework problems in Chapter 16. And then you have your final exam that will be open up Thursday, so just make sure you get that completed by Sunday at midnight, because after that our course will close. So with this week, when you look at Chapter 16, we discussed the importance of international business and the impacts today that almost every organization in one way, directly or indirectly, is tied to the foreign markets. I was watching the SEC championship game, and they talked about the Mercedes Bowl in Atlanta, Georgia. So Mercedes-Benz has a big presence in Georgia. So it's a good example of foreign direct investment, where the Germans have spent a lot of money, invested a lot of capital in the United States to produce cars in the United States. Many years ago, all the cars that were foreign cars were produced overseas and delivered here, but that's a very expensive way to do it, not an efficient way to do it. So most foreign cars today, they are built in the United States by American workers and sometimes with American parts. So they're just kind of more the human capital, if you will, in putting the cars together. So with that, companies obviously have a concern about foreign exchange risk, and that's what a lot of this chapter discusses. When looking at, say, the price of a euro, an American today, if you want to go out and buy a euro, it cost $1.19. That was as of Friday. So what can happen is if you have to pay someone in euros, say 6 months from now, and the euro appreciates in value, goes up, that means as an American, you're going to have to come up with more American dollars. Say it goes to $1.30 6 months from now. Well, that means that currency has appreciated in value. On the other hand, that means that the US dollar has depreciated in value. But there are ways to hedge. You can hedge through futures contracts or options contracts, but making sure that you are not exposed, that is the biggest concern. Some companies do not hedge; they just go with the spot price at that time, and that's the risk you face. So it's just the idea that, hey, we're going to win some, we're going to lose some, depending on with currency exchange rates. But if you have a big dollar amount and obligation, I'd say well over $250,000. You probably want to hedge that, because it can be a huge risk if all of a sudden you owe a bill and have to explain to your manager as well, it's going to cost us 30% more now because the currency appreciated. We didn't anticipate that. As you read this chapter, you're going to notice what's called like a direct rate and indirect rate. If you ever want to find like the other, the reverse, the currency exchange rate, say going back to my example of an American costing them $1.19 to buy 1 euro. Well, if I would put 1 in the numerator and put that $1.19 in the bottom, I could find out from the Europeans' perspective how much does it cost for an American dollar. And when we do that, it'd be about 84 cents, or I should be careful, cents, 0.84 of a euro to buy 1 US dollar. So, and these rates, they're posted every day, and you can see these, whether they appreciate or depreciate. So, the last part just discussed this week, it talks about interest rate parity and purchasing power parity. First, with interest rate parity, the idea you think about, especially investments, that interest rates can change. And say it may have a higher nominal rate in Europe, but investors should be taking into consideration what we call real rates of return. What is that inflation rate in the other country? So if, say, interest rate in Europe is higher and it's the same relative risk, you'd start to see an outflow of money to buy bonds in Europe. But again, pushing up the price of those bonds should push the interest rate down for that investment. So the idea is that it should all get in line, that interest rates have the same parity across nations. That's not always the case. It's hard to try to anticipate inflation, but it is a theory. Something else I want to mention too, just tied to that in the risk, if you're investing in a foreign portfolio, a lot of us have mutual funds that sometimes they have a piece that are invested in international funds. And going back to the idea of appreciating and depreciating, if you buy a French company, and if that French stock goes up in value and the euro goes up in value, actually when you convert those back to dollars, you're going to get more back. So your returns have gained quite a bit. But the opposite can happen too. The French stock can go down, and if the euro depreciates in value, when you try to convert those dollars back, you're going to be much worse off. So, with international investing, there's definitely more risk associated with it. And that's why portfolio managers will also potentially use foreign exchange hedging to try to protect themselves. The last part, purchasing power parity, we had probably talked about this before in economics. So you've taken an economics class with me. But the idea is that, between borders and countries, that if a product is perhaps cheaper in Canada, everybody would go up to Canada and get that product there and bring it back to the United States and sell it at the higher price. Well, those are supply and demand factors. If all of a sudden the product is leaving Canada, there's less supply up there, and less supply means that the price would go up there, and as more comes into the United States, the price would go down. So we would hope to see this, but it doesn't always happen because there can be different elasticities of demand based on what a person in one country say is their demand for that product versus the demand in another country. So those demands can vary differently. So, well, that's it for this week. So again, no forum discussion this week, but just make sure to get that last homework questions in and get your exam completed on time. And look forward to talking to you online. Take care.